The value of a business is contained in the books of accounts and the respective source documents. And that is why it is very important for us to have a robust system of how we maintain our books and records, including our source documents. You will find that we will experience problems every time our books are in shambles. And I can challenge you on this point. Show me your books, show me your records, show me your source documents, and I will predict the future of your business just by looking at the books. Therefore, we need to put more attention and emphasis when it comes to our books and records, because those records are the repository of value. Our value is contained in those records. That's how important those records are. And therefore, we need to make conscious decisions. We need to invest in those records such that any time we want to know the status of our business, that information can be made available depending on the need. It doesn't matter whether you are running a manual system or you are running an automated system. Either way, we should be able to find out the information whenever it is needed from these records. So, when we come up with our processes, we must ensure that our processes are streamlined. Our processes are well streamlined such that there are no gaps, and such that at every stage of our processes we have got our evidence that comes in the form of these records, that comes in the form of these source documents. We must also ensure that we have a proper approval system such that we know who is responsible for raising these documents, such that at the end of the day, everything that happens is legitimate. Let's remember that. We have to ensure that our processes are seamless, they are streamlined, and they are complete. There are no gaps between where things can sneak through. There are no leakages. Remember this. If we don't have proper records, we are bringing grounds for the leakage. Now, when it goes to that, let's remember about the fraud triangle. How does the fraud triangle work? The fraud triangle has got three elements. It's a three-legged stool. On one hand, there is the pressure that the employee is experiencing in their lives. On the other hand, there is a justification that the employee can give themselves. But the most important one is the opportunity. So, as a business entity, we must ensure that we have got proper internal control mechanism such that we reduce the opportunity. That's the third leg in the fraud triangle, the opportunity. We must reduce it to zero if it's possible. Because there is no point in catching a fraudster. What is important is a deterrent. Because by the moment we are catching the fraudster, your resources are gone. Your resources are depleted. You see? And that's why we are saying that for us to be able to run a robust business or a robust enterprise, all of it starts with how we are keeping our records and our books. Are they secure? Are our books secure? Are they safe? Are they robust? Meaning, are they strong and healthy? Can they be manipulated? And now that leads us to another point. And that point is that your accountable documents, by that I mean this, accountable documents, those are your checkbooks, those are your receipt books, those are your job cards. How secure are they? Is it possible for someone, for a trusted employee, to come with their own duplicate source documents, duplicate receipt books? This has happened many a times. As we speak currently, it is happening, whereby customers come and pay and they are given a fake receipt. And then it takes you a whole year, sometimes 2 years before you discover that. Yes, you have discovered it. Yes, you have caught the perpetrator, but the perpetrator has nothing to repay. The perpetrator cannot be able to repay the damage. You see? So you have lost already. The business enterprise has lost the resources just because the books are in shambles. And just like I said before, show me your books and records, and I will predict the future of your business. That's how important these books and records are to the business. What do you have if you have got no records? You've got a fleeting value. The value of your business only exists in your imagination. You see? Now, if at all you are running your business and you are basing your activities on memory, you are running your business on your memory or the memory of your employees, you are just a disaster that is waiting to happen. Because it means that you are suffering from a disease we call corporate amnesia. That is corporate amnesia, and it has got dire consequences. You cannot run your business and your investment therein and your resources therein based on memory. Remember, the employees, no matter how trusted they are of transient nature. Ask yourself this question: if your trusted employees are to leave today, can your business continue tomorrow? And if the answer to that question is that you have got jitters and doubts, it means that you need to go and work on your processes and your books and your records. Because if there are books and records and processes, anybody can take over. Anybody can come in and fit in and continue and be able to tell where things are going. You see? So this is a challenge to you entrepreneur, to you businessman. Ask yourself, do you have sleepless nights, bad dreams when you think that one of your key employees can leave? And if that is the case, do something. Do something to do with your processes, streamline them, make them seamless, your source documents, how you store them, the procedures around that, the policies around that, work it up, the workflows, so that whatever happens, there is always a trail. There is a trail of what has been happening. And that's what we normally call audit trail. There's an audit trail whereby we can trace every transaction back to its origin. You can go backwards and be able to see, how did this transaction come about? Where is the invoice? Where is the order? Where is the receipt? Where is the job card? Where is the time card? All of those, you can trace them backward so that your transactions can become legitimate. Because illegitimate transactions stands for business leakages. And for how long can you sustain a leakage? And a leakage that you don't even know that is existing. You're not even aware that the leakage is existing. Is an underground seepage of which even qualified plumbers will struggle to identify where the leakage is happening. So, the books of accounts are that much crucial. They are so crucial that you have to come up with a conscious plan. Those plans that will be suitable for the type of business activity that you are undertaking. You have to be very innovative when it comes to this, because whatever you have, whatever system you have, must answer to the problems and activities that you are undertaking. So you need to align things so that these things can add back to the activities such that all the records are in place, all the evidence is in place. You see? So the records are a repository of value. That's a key point. Is the repository of value is where the value is stored. Without it, our value is neither here nor there. It becomes free for all. And that's why we have to emphasize these records. Now, moving on. We have mentioned about the records. And we've mentioned about the source documents. But then, what do we record in the books of accounts? We don't record everything. Some of the documents are supporting documents. They support the events that are taking place. And those events are the business transactions. You see? So, you must ensure that those records are safe and secure, like we said. But not everything is entered in the books of accounts in the double entry system. Not everything goes there. But this other information is put as a backup, is a source of evidence, is what is used for us to be able to enter in the books of accounts. Is what gives us the evidence. Is the evidence for the transactions that are taking place. So, having said that, then, let's now pay attention to what we want to do today. What we want to do today is to record the business transactions in the books of accounts. And these transactions will come in many ways. And that's what we're talking about. The source documents will be the evidence of those transactions. And we can only record transactions that have got evidence to back them. Let's remember that. We only record transactions based on the evidence. Otherwise, again, it's going to be free for all if you can just record anything. So, in front of us are transactions that took place in a particular business, which is WPT. And this business is a sole trader. Yeah? A sole trader is a business with less formalities. It's a business that does not require to be formalized. It's not incorporated. And most of the big institutions we see today, enterprises that we see today, they started as a sole trader, and then they kept on growing and upgrading. Because you'll find that for a sole trader, you are one and the same. There's no difference between you and your business. You become one and the same. All the risks of the business, you take them. And all the rewards of the business, you also take them. If their business debt, they also become your debt. You also inherit them. So, a sole trader is a one-man show. Now, here are some transactions that were registered. And we need to have an opportunity of seeing how to record them in the books of accounts. For the beginners, you have to pay attention on how we record these transactions. So, this is a microcosm of transactions that can take place in a business, which is a sole trader. Just a microcosm. But it represents all the elements and all the items that we need to know. Now, remember this. Everything in life has got a formula. everything in life has got an approach. Everything in life has got a way in which it is done. That is why you have to pay attention. Let's look at these transactions. They happened in the month of June 2017. It's for a sole trader. From June 1 to June 30. Those transactions were recorded. And remember, these transactions need to have a date stamp and a time stamp. If it's automated, every transaction, if it's automated, if at all we are using the software, we will have a date stamp and a time stamp. All of that is to help us to create the audit trail, to create the tracks. We can track backwards, back up to the origin. We can go back up to the origin. Remember that. So we have our date stamp, our time stamp for audit trail. When we are auditing, those are the kind of things that we verify. We verify how they happened. And if there's a gap, we'll be able to see those gaps. Because there's always a track, a footprint. There's always a footprint of what is happening or what is going on. So, looking at these transactions like that, you should start forming ideas as you look at these transactions. Now, first things first. In accounting, we said we summarize, we structure, we give meaning. We summarize, we structure, we give meaning. So, for these transactions, you should be able to tell how many accounts are going to be involved. And remember this, very importantly, that you don't open an account twice. Once you open an account once, that account remains as so. When there is another transaction that has to be recorded in this account, it has to be entered in the same account because we are classifying. This bookkeeping, we are classifying, we are sorting things together depending on their similarities. No, we pile them together, pile them together, pile them together. So you only open an account once. This is for the beginner. You only open the account once. And if there is another entry that comes later on in the month or in the year, it will be entered in that very account. You don't open an account twice. As long as a similar transaction comes about, you enter it in the account that was already opened. That is a key point for a beginner. For example, in this case study that we are having here, we can be able to count the number of accounts that we are going to open. If you look at transaction number 1, started business with capital in the bank. So capital account and bank account will have to be opened. That's the very first day of business. The second day, we bought goods. When we buy goods for selling, so this is a trading company. You buy and you sell. You buy and you sell. It could be a service, it could be manufacturing, it could be something else. But this particular one is a trading company. You buy goods, you sell. You buy uniform, you sell. You buy shoes, you sell. You are boutique. Okay? So, already, second one, you have to open purchases. That's the account you're going to open. Purchases, and then you open the respective accounts of these creditors. If you buy from people, they become your creditors. If you don't pay them, if you do not pay them outright, they become your creditors. So, here you are going to open purchases account and the accounts of creditor number 1 and creditor number 2. That is PK and DK. Okay? So there you are again going to have 3 accounts. Okay? You are counting them because you have to open them. You have to open your books and open these T accounts. They will be represented in the form of a simple T account. Okay? Not with so much detail. Just a T account, not with so much details. Then we move on. Paid insurance. It means one entry will go to the bank, which we already opened. Then we open an insurance account. So the bank cannot be opened again. It's already existing. That's what I want you to see. That for an account which is already existing, any other entries that comes in, you just add them in there. You just add them in there. Okay. Then cash sales. It means you are going to open an account called cash, and another account called sales. Sales and revenue and turnover means the same. Sales, revenue, turnover are one and the same thing. You have to get that. They are one and the same thing. Only the terminologies are changing, but they are one and the same thing. Then, wages. You are paying wages. So, open a wages account. The cash account is already existing. You can't open it again. You just record. In this particular date. Date 5. Now, date 6. Goods were returned. There it becomes a bit juicy. Goods were returned because they were not in good condition for whatever reasons. Maybe not the right size. Maybe they were faulty. So, they are returned back to an account which you already had. DK. DK is already existing. Okay? So, we will not open DK twice. But we are going to open a return, purchases return account, or return outward. This one is a juicy part. This one always has problems. This one, I'm the accounting integrity specialist. These ones, beginners will always have a problem to see that. I'll try to simplify it. I'll try to solve it for you. I hope you pay attention when I come to that. Then, you sold goods. When you sell goods, sales account is already opened. You don't open it again. Okay? You just record that part. Then you open the account of the customers. JK is a customer, GK is a customer, MG is a customer. You see? Now also remember that these are now customers. It's the opposite of creditors. Customers is your money. They will pay you later. This is your money. Creditors, this one is a liability. You have to pay them. So here money will go out, here money will come in. That's the difference. It's the flip side. Flip side, the opposite side. If it's a customer, creditor is the opposite. If it's a creditor, customer is the opposite. Flip side. And we are going to have a lot of flip sides in accounting. Remember that? Or in bookkeeping and accounting. We are going to have a lot of that flip side. So you better pay attention. Don't get lost. Don't get lost, because if you cannot get it at this stage, you have got no way of proceeding. You have got no chances of proceeding. You have to get it at this stage. You have to come back at this stage and make sure you master. Don't go anywhere before you master this. You face problems. How are you going to navigate? How do you navigate in a desert or in the high seas without a compass? Without a working compass? Or if you don't have a compass, then without knowing how to read the heavenly bodies, reading the position of the stars, position of the moon, if you don't have those navigation skills. Now, again here, in accounting, make sure that you camp here. Once you camp here and master this, I guarantee you, the rest of the journey will be very enjoyable, because accounting is the most enjoyable subject in the world. It's so fulfilling. It's like a game of numbers. It's like a puzzle. It's a piece of a puzzle. It's one piece of the whole puzzle. It's just one piece of the whole puzzle. Then you bring them together, and then the whole puzzle is complete. It's beautiful. It's complete. You bring every piece where it is required, and it can show you with the shape. The shape of the piece shows you where it should fit. There's no guesswork in accounting, by the way. If you are doing accounting and you are getting 50%, you are struggling. You don't know accounting. Accounting, you get 80% because you didn't have time to finish. 80% is the minimum. If you know what you are doing, there is no guesswork. And these things don't change. Once you master them once and for all, they will not change. So you better camp here. Depending on your rate of capturing and ingesting, you better camp here. Okay, we are on number 8. Number 8, you bought a car. So open a motor vehicle account. The cash account is already existing, you just record. Okay? I'm sure you are counting the number of accounts we are going to open. You are counting with me. You are counting with me. Then, we bought goods. When you buy goods, that's purchases. Always look at the terminologies. The terminologies may confuse you. You see, we bought motor vehicle, but we are opening a motor account because that is an current asset or a long-term asset, if you like. But again, we are buying goods, but now we are recording them in the purchases account. The purchase account is the account which holds those goods that have to be sold. Because if you look at our business model, we are buying and selling. So when we buy, we record it in the purchases account. When we buy those goods for the selling, not buying everything. When you buy those goods for the selling, you have to include it in the purchases account. So we will not open it again, it's already existing. Okay? Then paid PK was a creditor. We have paid them by check, meaning that we paid them by transferring to their bank account. We did a direct transfer. Of course, I know the check is getting outdated. I know nowadays we use mobile platforms which are in our fingertips. I know that. But I also know in some jurisdictions the checks are still being used. Okay? Now, 40 goods were returned to MG. Now this becomes return out. 40 goods were returned to us. No, this is now return in. Return in because MG is our customer. That is return in. Okay? The other return was return out because this was our creditor. So when our customers return, that is return in. It means that those goods were not sold because they have been brought back for whatever reasons. And of course, it's a big cost. It's a big cost if you are running a business where things can be returned to us. That stands for a problem. It shows we are having a problem in the way we are operating. And that problem better be sorted because it's going to kill our reputation. It's going to become a logistical nightmare. Okay. There's a lot of handling. There's a lot of transportation. There's a lot of work involved here. And this work does not add value. Doesn't add value. It's actually destroying value. Then it becomes a waste. It becomes a cost which hits on our bottom line. Every cost ends up hitting, especially unnecessary cost. It hits on our bottom line. And that is not good business management. That's poor business management. We are losing money. Money is leaking. Then we took a loan. When you took a loan from this bank, and the loan was put in our bank account. So our bank is already existing. Bank account is already existing. So we'll just enter that and open a new account. It was not existing. Remember, we are only opening accounts not existing so far from the time we started. Okay? Those are the accounts we open. Those that are not existing. Then, this owner of the business, the proprietor of the business, took out money in the form of cash from the business. You see, they took out money from the business. So effectively, they are reducing the capital. When you take out money, or even goods, not just money, even goods, you are running a shop and you take sugar, cooking oil, and rice to go and cook in your house. You are reducing the capital. And most of the small businesses, that's what they do. And they do it unconsciously. So I want you to be conscious of what you are doing. I want you to know what you are doing. It means that you are effectively reducing your capital. Effectively, you are reducing your capital. That's what is happening. Then we have got transport. We paid transport for our purchases. When we bought the goods, we also paid transport for them. That one is called carriage inwards. And this is how it is treated. This is how it is treated in account when we are preparing that income statement. That is how it is treated. And then, when you are selling to our customers, you also incur some transport cost. Yeah? So you incur some transport cost. That's now carriage cost. That becomes carriage cost. Yeah? That's carriage cost. When you are selling to your customers. It's also a cost to the business. And that's how it is treated when it comes to preparing the income statement. This one will be treated slightly different, but both of them are costs. Remember that. They are all costs. Then, the last transaction has got the VAT element. The VAT will only happen to the businesses that are already registered. This is for registered businesses only. Those that are not registered should not be affected by VAT. Assuming our business is now registered at the 30th of June, it was registered for VAT. Now we want to see how we are going to record the transactions that has got a VAT element in them. Again, this is an area that gives most of the beginners a problem. Here, expect a problem. I'm PK, you are accounting nitty-gritty specialist. I know where the problems are. Here there is a problem. I know it. No doubt about it. On the return out and return in, there is a problem here. I expect a problem there as well. Because things don't just flow. Sort of it becomes a bit juicy, a bit spicy, just a bit. But if you get the logic, you can never be carried away. You cannot never be carried away. You'll still be able to keep steady. You keep steady and firm, and you'll be able to flow with the logic. Because the most important thing in accounting is to form the accounting logic. Once you have the accounting logic, you can never be lost. You know, once we come from here, this is where we go, and then this is where we go. When we come from here, is where we go. Then is the next place we go. That's the accounting logic. And you must start by forming that accounting logic. It's the only thing that will ensure you are not lost, or you don't start forming the accounting phobia we talked about. Because already you have formed the accounting logic, which is not difficult to form. There is a lot of common sense in accounting. A lot of common sense. You'll be so surprised at how much you know. You'll be so surprised that you know so much in accounting. Just to bring it together and structure it properly. That's all we need. Bring it together and structure it properly. So, like I said, this is where you camp. Make sure you follow me, because you will not need any other person after this. This will be it. You will not need any other person. You will not need any other lesson if you follow. Now, how do we record these transactions in the books of account? Let's remember first of all, where are they coming from? They are coming from the source documents. They could be orders, they could be receipt books, they could be check tabs, they could be job cards, they could be cash registers. They are coming from all those, so they could be debit notes, credit notes. They are coming from all that range of source documents. That's the evidence behind these transactions. The source documents, of course, will not be recorded in the double entry system, but it has to be filed, because that's our evidence. That's our store of value. That title deed of your land will not be recorded in the books of account, will not be recorded in the double entry system, but we need to have it somewhere safe, maybe in the bank for safe deposits, or somewhere in the safe, somewhere that you know that you cannot easily lose it. It's a store of value. Yeah, that document that represents the title of your car, whatever you call it, in whichever jurisdiction, blue book, logbook, whatever you call it. You see, that represents the value. It has to be stored somewhere, but it will not be entered in the double entry system. But it's a source document that will help us to now enter, because we don't just enter everything and anything. We enter something that has got evidence behind it. All right. Now, let's see how to record. Let me give you the tips. The tips take us back to something we talked about. Those who are following me, we talked about the elements of financial statements. We talked about that. Elements. We talked about this before, and we said there are 5 plus 1. We said there's something called the assets. These are the resources that the businesses use, the infrastructure of the business. We said closely followed by expenses, the day-to-day activities. 1, 2. Then number 3, we said we have got our revenue. And remember, our revenue comes in many forms. It can be sales, it can be turnover, it can be sales, Don't get confused. Don't get lost when it comes to that. Don't get confused. Don't get lost. Then we have got number 4 is our liabilities. Liabilities. Whatever you owe to other people. Whatever you owe to other people. Whether it's finance or it's goods, whatever you owe to other people. You are using other people's resources. It becomes a liability. And then number 5 is your capital, is what you introduced into the business. What was introduced into the business for the business to start by the proprietor, by the promoter. The promoter, what the promoter put in. Then the other number 6, we can just call it other. For a reason, we just call it other. The other issues not represented by the 5. Now, what I need you to know at this point, because we have already talked about the elements, now we want to use them to record transactions. Now we are using. That's why I told you last time that this is a foundation of accounting. I told you this is an accounting campus. So I use those terminologies. Foundation for you to navigate, for you to know what you are doing, for you to know where you are. So when you are in an asset, where are you? We said an asset will always depict a debit balance. That's what we said. Debit balance. If it doesn't do that, then you investigate. There's likely to be a problem. And of course, we talked about the exception of a bank when it's overdrawn. When you've got a bank overdraft, then that balance will change into credit. But all the other assets by default are going to depict a debit balance. By debit balance, what I mean is this. If you want to increase the value in this account, you debit. And if you want to reduce the value in this account, you credit. That's the meaning. That's the meaning. Whenever you debit in this account, you are depositing. The value is increasing. Whenever you enter a credit transaction, you are reducing. You are withdrawing. You are reducing, you are withdrawing. The balance comes down. Okay? So, at the end of it all, these elements will represent a debit balance. When everything else is equal, it will give you a debit balance. When you want to increase it, you put the entry on the debit side. You record on the debit side. Then that balance will be, it's like you are adding. When you want to add, debit side. When you want to subtract, credit side. It's as simple as that. It doesn't have to be more complicated than that. As long as you know what you are dealing with is an asset. That's why you start by identifying. Identify that item. Once you identify, oh, it's an asset, oh, so whenever I debit, I'm increasing it. Whenever I debit, I'm adding. Whenever I credit, I'm reducing. It just goes like that. You start by identifying so you can know the characteristic, the behavior. So, anything under this family or in this family will behave like that. And equally true is anything under the expenses will always give us a debit balance. Same thing, as long as you identify that the item you are dealing with is an expense. If you want to put a value into it, you are gonna record on the debit side. However, if you want to reduce, to subtract, you record on the credit side. That's the basis. That's the basis. That's how it works. It doesn't have to be more complicated than that. You know, once you master that, then your understanding is well grounded. You can't be shaken. You can't be shaken. You can't be tricked. Even if things become complicated, you just ask yourself, oh, generally this transaction represents what? Is it an asset? Is it an expense? Once you get that, you are done. You don't have to get more details than that. Then these two, they go together. They are relatives. The same family. Same family. Yeah? And then revenue. Whenever you see revenue, remember that it will always represent a credit balance. Meaning, whenever you want to increase, you credit in this account. Whenever you want to reduce, you debit. Whenever you want to increase, you credit. Whenever you want to reduce, you debit. That is how the revenue account behaves. Everything with how it behaves. Liabilities is another relative. Credit. Capital, credit. Now you can see that these three, they operate together. These three, they operate together. And let's not forget this. We are still in the journey of developing our financial statements. We are still in that journey. We have taken a step backwards to record, to see how the transactions are recorded. Then these transactions will go through a distillation process until it reaches to the financial statements. Remember that. We go through a distillation process. Yeah? Now we have got the elements, the accounting logic. Note this. We have got the elements. From the elements, we are recording the transactions. After we record the transactions, we balance them off. Then we will extract a trial balance and see whether it's going to balance. See whether it's going to balance. And we say a trial balance is a clever fool. It will still balance when there are problems. Yeah? But it will help us to check the arithmetical accuracy and that the double entry has been followed. It will help us on those two ends. Very, very well. And of course, you cannot imagine to prepare the financials without going through a trial balance. We said it's a master file. Remember, we said it's a master file. Very important stage in the development of the financial statements. Then from now, the trial balance, you get your balance sheet, which is a statement of financial position, and you get your income statement, which is a statement of financial performance. Okay? That's what happens. So at this stage, we are now talking about the elements. And remember, all financial statements are cut from the same cloth. That cloth is the elements. For uniformity and for homogeneity, they are cut from the same cloth. For uniformity and for homogeneity, things must be homogeneous so that you can compare entity by entity. So they are cut from the same cloth. That's a critical point. That's a nitty-gritty. That's a take-home point. They are cut from the same cloth. And the cloth is represented by these elements. The other, it can be credit, it can be debit. That's the other. Either way. As we are going to see, VAT is going to fall under that, under this. Okay, so now we know that as long as our transaction is an asset, what should happen? Is an expense, what should happen? Is a revenue or sales or turnover, what should happen? Is a liability, meaning creditors and loans, what should happen? Is our capital introduced to the business, what should happen? Now, let's now do the actual work. Are you ready? Are you ready? Are you ready? We want to do the actual work now. It is June 1, and we started the business putting £20,000 into the business bank account. How do you record that? Okay, you need to open two accounts. The first account is capital, the other account is bank. Here we have our page ready. Our page is ready. So we have got our capital account. This side is the debit side. Left side is the debit side. Then the right side is the credit side. There we are. And the amounts are in pounds. Let's remember that we are dealing with money. And money has to be denoted in currency. Money has to be denoted in currency. And the year is 2017. The year here is 2017. There we are. So, and it is June 1. June 1 is the date of the transaction. We said date stamp and time stamp. And now remember this also. In accounting, we record one transaction at a time. Irrespective of how many tasks, how many entries a task can contain, irrespective of that, we record one at a time, starting with the earliest. starting with the oldest. Yeah? No, starting with the earliest. Starting with the one that came first. And then we go down to the oldest. So it's the earliest to the oldest. So there's no way you'll find a transaction that happened on the 30th of June coming before the transaction that happened on the 1st. No, we follow sequence. That's just logic. That's common sense. We follow sequence. You see? There's no way you'll find something for 2nd June coming before something for 1st June. No, we follow that sequence so that things can fall into place, so that things can be in order. That's why we do that. Okay, so you open a capital account and a bank account. Always two accounts. Always two accounts. Because the double entry system by itself means what? It means that there is a debit for every credit. That's the duality. That's one rule. That's one principle of accounting. That whenever you are dealing with transactions, that they have to be dealt with twice. Two accounts and then two records. One on the debit and one on the credit. Every time. So always two goes in pairs. Always two. Always two. Always two. A debit and a credit. A debit and a credit. Yeah? One account takes debit, another account takes credit. Depending on that particular transaction. What does that transaction represent? Now we have opened our bank account again. Left side debit, then right side credit. We have got our pound sign there, and the year is the same. Yeah, it's the same 2017. Both sides. 2017 pound is June 1. Now let's see. We now want to record this transaction. What takes the debit and what takes the credit? First of all, for us to decide what takes the debit and what takes the credit, we have to determine this account represents what under the elements. And this account represents what under the elements. Now, our bank, that's our asset. Is our asset. And when our asset is increasing, we debit. We just identified the first entry. We just identified the first entry to make. So our bank will be increasing. Whenever an asset is increasing, we debit. That's what we said. We debit. You see? So we'll come here. It's June 1. The other account that is affected is capital. So capital is the other account in the book. And what is the figure? The figure is 20,000. Our 20,000 is right there. That's our 20,000. Yeah? We don't have a lot of space, that's why we are squeezing. So our capital is the other account. So you come to the capital account. On the credit side, you are going to enter that transaction, and the details will be the bank, because that's the opposite. The bank is the details. Again, this is June 1. Then that's bank 20,000. You can see we have just recorded our first business transaction. We have just recorded our first business transaction. And what do we use? We use the elements to determine where to record. So imagine if you don't know what to use, you are going to use guesswork. Know what's going to happen? Things will be in shambles. If you don't know what to look at, if you don't have your compass, then you will end up going anywhere. You see? So that's why we started by establishing our base. And our baseline are the elements. Know how they behave. So whenever we are going to enter on this debit side, this balance will be increasing. Whenever we are going to enter on this credit side, this balance will be reducing. It will be subtracting. Here is an addition, here is a subtraction. Okay, so let's look at the next one. The next one is we bought goods on credit from 2 people. Okay? We bought goods. Therefore, there's a purchases account. There's a purchases account here. Purchases account is right there. Debit and credit. Pounds and pounds. Right there. Then, start with the first entry. We say one at a time. PK squared is a creditor. So PK squared is somewhere here. PK squared account. It's right there. So it's gonna have debit and credit and pounds and pounds. Let's start by entering that transaction. We bought 3,000. Yeah? Bought 3,000 from VK, so we enter the 3,000. How do we enter? Our purchase account is an asset account. So it's only increased when we do what? When we debit. So 2017 and in 2nd June. June 2. The other account involved is PK. PK is the other account involved because you have to show the other entry. Where is it going? Where is the other entry going? 3,000. It's right there. Then you come here, PK. What is PK? Is a creditor. Because we took goods and we did not pay for them. Therefore, it's a creditor. So, what happens to a creditor's account? It should have a credit balance. So, we come in here and we enter. We enter on the credit side. This is 2017 and this is June 2. And then it is purchases. It is purchases. Purchases and the amount is 3,000. 3,000. It means we have entered that transaction. So there is a credit and there is a debit. This is a liability, this is an asset. See how these things are going. Yeah? Take a moment and see what is happening. We are being guided right here. What is guiding us? So we know if you want to increase an asset, you debit. If you want to increase a liability, you credit. You see? And every transaction must give you 2 entries. One on the debit and one on the credit. And it also have to give you 2 sets of accounts. So you have to open 2 sets of accounts. Yeah? Then we can go on. Then we bought again. We bought again, same date. We bought on credit from DK. Now, we come here, same date. June 2 is an asset account. We bought again, DK 1.2. Then we come and look for DK. DK, we have not opened DK. DK, we can open in here. DK account. What is DK account? Is a creditor's account. Debit, credit. Yeah. There we are. The year is 2017. Is June 2. June 2, 1.2. No, not on this side. Not on this side. That's an error. So, June 2. June 2. The other account involved is purchases. 1.2. You see, you have debited and you have effectively credited. By first of all asking you that account represents what? Looking at the elements, that account represents what? Once you get that clear, you can record anything and you cannot get anything wrong. No, not unless you're not paying attention. Not unless you are lapsing, your attention is lapsing. That's the only time you can make an error. That's a human error. But otherwise, the logic, if the logic is there, you cannot make an error. You can make an error. You can also self-correct yourself. Because you know the logic, you can even go to an extent of correcting yourself. Self-correcting. That's what we're talking about. Let's look at the next transaction is insurance that you paid by check, 850. So let's open an insurance account here. Insurance is here. Debit and credit. Insurance falls under the category of expenses, right here. And we said expenses are debited when we want to increase them. They always have a debit balance by default. So any increase will be recorded on the debit side. So what we do here then? So our insurance we know is debit, yeah, and that is June 3. The other account involved is bank because you paid by check. You can also transfer if at all your checks are outdated. You can also transfer directly, even with your mobile platforms. So that was £850, 850, and you can see this is a transaction between two assets. So two assets can also deal with each other because it is insurance versus the bank, and the bank is an asset. So when the balance in an asset is decreasing, what we actually do, we credit. So we'll come here. It is June 3, same year. The other account is insurance. It's insurance. Yeah. And then it's 850. So this time we have had an opportunity where two assets are dealing with each other. Two assets are involved. You see? Two assets can also be involved. So not two assets. No, an asset and an expense, not two assets. That's a mistake, not two assets. An asset and an expense are getting involved here. Those are not two assets. It's an asset and an expense. It's an expense, it's an asset. There was a mistake there. It's an expense, it's an asset. Okay? So both of them are in the same category. Yeah? So the expense is increasing, the asset is decreasing with this 850, because it's like saying 20,000 minus 850. Effectively, this is 20,000 minus 850. What is remaining? Okay, will be the balance. All right, let's look at the next transaction. The next transaction is the cash sales. Cash sales. So already we have got our sales account. Cash sales of how much? Cash sales of 15,000. So we have got our cash sales. So the other account we have to open, which was not opened before, is the sales account. Yeah? Sales account is under the revenue. Remember that? Debit and credit. It is June 4 of the same year. Yeah? Right there. June 4 of the same year. June 4. But the question is, where do we enter this transaction? On which side of the account? We are saying that liabilities are increased when you credit. So that amount is supposed to be credited in the sales account. So that 20 or 15,000, that 15,000 is going to be credited here. And then you open a cash account because it's not existing. There's no cash account existing if you scan through. So let's have our cash account somewhere here. Our cash account will take the what? The debit. We'll take the debit. So from the sales, June 4, we are getting from the sales account 15,000.